If you own Supermicro, you've been lied to before. Remember that on Tuesday. Tuesday after the close, Supermicro reports consensus wants $11.5 billion and 96 cents. But the company already told us half the answer 3 weeks ago. It pre-announced revenue near the low end of its own $11 to $12.5 billion range, and it guided 65 to 79 cents a share, adjusted. A revenue miss with an earnings smash is the shape everybody's bracing for. Going in, the stock sits at $31.13, 60% above its 12-month low and just over half its 12-month high. And nobody has had a worse decade in 4 years than this shareholder. Split adjusted, the stock touched roughly $123 in March 2024. By that November, it was around 17, that's minus 85%, and it happened while a short seller and the company's own auditor were both talking. Then a recovery, then another slide. 58.78 high, 1948 low in the last 12 months alone. It closed Friday at $31.13, still down about 75% from the peak. 15% of the shares outstanding are sold short. So what is the cheapest AI stock on the market actually worth? 9 times forward earnings going into Tuesday, while the revenue line doubles year on year. That's either the bargain of the cycle or it's priced correctly for a reason. I rebuilt every model that banks and the great investors use. Discounted cash flow, peer multiples, reverse DCF, 10,000 simulated futures on public numbers. By the end, you get one price and one word: undervalued, fairly priced, or overvalued. The models say it, I don't. And on July 21st, this company put out the single best press release in its history. Doubled margins, $60 billion of orders. In the same document, in the same week, it disclosed a fresh investigation into itself. So before those numbers land, we run the models twice, once for a company telling the truth, once for a company that has been caught not telling it.
Supermicro is 33 years old. Charles Liang started it in San Jose in 1993 with his wife, Sarah Liu, and a third co-founder called Wally Liu. Remember that third name. Sarah Liu was the company's treasurer for the next 26 years and still sits on the board. What they built was a business that bolts server boards into steel boxes. And here is the thing the headlines miss: that business has been getting worse at making money, not better. Gross margin was 18% 3 years ago, 11% last year. The last few quarters have run near 9, which is what happens when you assemble other people's chips and the chips get more expensive than the box. Then the AI wave arrived and the boxes got complicated. Liquid cooling, rack-scale delivery, whole data hall systems shipped as one product instead of parts in a carton. Revenue went from $22 billion in the year to June 2025 to $33.7 billion over the 12 months to March. In the March quarter alone, $10.2 billion, up 122% on the year before. And here's the wrinkle nobody puts on the bull slides. That same quarter was down 20% on the quarter before it. $12.7 billion, then $10.2, growing violently year on year, shrinking quarter on quarter. That's what a business looks like when its revenue depends on when a handful of very large customers happen to take delivery. And on July 21st came the number that made everybody sit up. The company had guided gross margin of 8.2 to 8.4% for the quarter. It pre-announced 15 to 17, both GAAP and non-GAAP, roughly double in 90 days, with the reason given in the filing as, quote, primarily due to a favorable customer and product mix. That number is preliminary and unaudited, and it is worth holding both of those words in your head. The stock closed up almost 20% the next day anyway. Why it matters so much: at 8%, every extra dollar of revenue is almost all cost. At 16, the same dollar carries twice the profit. The company had guided fourth quarter earnings of 65 to 79 cents on a non-GAAP basis. Double the margin, and that arithmetic doesn't survive contact with the release. It also wouldn't be the first time. In the March quarter, the company earned 84 cents a share on an adjusted basis, against a consensus of 62. A 35% beat, and almost nobody noticed because everyone was reading the other filings. Which is why it screens like this: 9.2 times forward earnings, 0.83 times enterprise value to sales. Dell trades at 24 times forward, HPE at 14. Same wave, same customers, a fraction of the price. But hold the two numbers side by side before you call it cheap, because Dell earns a 19% gross margin and HPE earns 34, and Supermicro has been earning 8. On peer comps adjusted for that, the latter puts the first rung at $35.40, one model in. The same release carried a bigger number, $60 billion of new orders received during the quarter, 60, against $33.7 billion of revenue for the entire trailing year, nearly 2 whole companies booked in 90 days. Read the rest of the paragraph. The company's own filing says some of those orders, quote, may not constitute firm commitments and may be subject to cancellation or delays. That is the company in a legal document telling you the headline number is not a backlog. Backlog is contracted, orders are intent, and the release names no customers, gives no conversion schedule, and no concentration. So the honest version of the sentence is this: $60 billion of demand signal, definition pending, from a company whose definitions have been the problem before. And note what the 2 headline numbers do to each other. Better mix on weaker sales. The company says the quarter came in near the low end of its own revenue range and the profit on it roughly doubled. That combination isn't impossible. Selling fewer, richer systems does exactly that. It's just the one combination that's hardest to check from outside in the one quarter that hadn't been audited yet. Which brings us to the reason this stock is cheap. It isn't the servers. Dates, no commentary, just the record, 2018. Filings delayed for nearly 2 years. Nasdaq suspends trading in August and the shares move to the over-the-counter market. They are relisted in January 2020. August 2020, the Securities and Exchange Commission charges the company with what it calls widespread accounting violations. Revenue recognized early, expenses understated, $17.5 million penalty. And Charles Liang, in the commission's own words, not charged with misconduct, is required to repay $2.1 million in stock profits under the clawback rule. Not accused, still paying. August 27, 2024. Hindenburg Research publishes. Their headline says fresh evidence of accounting manipulation, sibling self-dealing and sanctions evasion. Those are Hindenburg's claims, and they are the claims of a short seller who stood to profit from them. The core one, $983 million paid over 3 years to 2 suppliers run by Liang's brothers. The next day, August 28th, the company delays its annual report. September 26th, the Wall Street Journal reports a preliminary Justice Department probe. October 2024, Ernst & Young resigns as auditor, mid-engagement. In its own letter, it says it is, quote, unwilling to be associated with the financial statements prepared by management. Read that again. The auditor quit. That is the rarest event in this entire ledger, and it is the one professional investors never fully forgive. December 2nd, 2024. A special committee reports no evidence of fraud or misconduct by management or the board. February 25th, 2025. The delinquent filings are cured. That date was the exchange's own deadline, so the company filed on the last day it had. Delisting avoided a second time, and in those same filings, material weaknesses in internal controls. The auditor's opinion on those controls was adverse, and as of this March they had still not been fixed. March 2026. The Justice Department indicts 3 people, including co-founder Wally Lau, over an alleged scheme to sell around $2.5 billion of restricted servers through a Southeast Asian intermediary. Of that, roughly $510 million is alleged to have reached China. Supermicro itself is not a defendant, and an indictment is an allegation, not a finding. June 29, 2026. Taiwanese prosecutors search Supermicro linked offices and question 4 employees. The company denies the word raids in an open letter on July 1st, and the authorities confirm the company is not a target of that investigation. And then July 21st, the release with the doubled margins and the $60 billion in orders also discloses the board's own independent review of alleged export control issues, which the filing says could affect, quote, our forecasts, these preliminary results and prior period results. That last clause is restatement language. It arrived in the same press release as the best news the company has ever printed. Models run twice. The comeback case takes the 15 to 17% margin as durable and prices a company earning real money on the AI wave. Discounted cash flow lands at $113.29. The trust discount case keeps margins near the old 8 and applies the higher return investors demand from a company that has restated before, $14.27. Reverse DCF stops asking what it's worth and asks what the current price already assumes. If the margin is real, this price already assumes revenue shrinks about 27% a year for a decade. If it isn't, the very same price assumes 80% annual growth. 4 models in, 2 ladders, and they disagree by a factor of 8. And one number sits underneath both cases. Free cash flow, minus $6.85 billion over the 12 months to March, most of it inventory sitting and racking waiting for a customer to take delivery. $9.15 billion of debt against $1.31 billion of cash as the March balance sheet last showed them. So a company booking $60 billion of orders is also burning cash faster than it earns it. That's normal for a hardware ramp. It's dangerous for a company that needs the market to extend it credit and patience at the same time. And it cuts the other way too, which is the part almost nobody says out loud. This company generates cash the moment it stops growing and burns it every quarter that it grows. The inventory is the bet. One more thing the models have to hold. 15% of the shares are sold short going into Tuesday. That cuts both ways, and it's worth saying plainly, a clean print doesn't just improve the math, it forces buyers who never wanted to own this. A messy one does the reverse. Neither of those is valuation. Both of them move the price, and only one of them is in the models. Two ladders that disagree. The next model refuses to pick. Instead of predicting one future, the machine rolls the dice on 10,000 of them. Some where the margin miracle is real and permanent, some where it was 1/4 of favorable mix, some where the review finds something. Every roll prices the stock. Stack 10,000 answers and you don't get a guess anymore. You get the shape of the future. The dice named gross margin, the 8% world against the 15% world drawn across everything in between. Revenue, the company's own path against consensus. Order conversion, how much of the $60 billion becomes invoices. Working capital, because the inventory is the cash. And the governance die, the one nobody else models. The probability that the board's review changes a prior number, and the extra return investors demand while that question is open. Fixed seed public inputs. So here is the shape of it. The median of 10,000 futures lands at $41.33. 90% of them land between $7.69 and $120.87. And 65% finish above Friday's close. That spread is the widest we've put on this board, and the width is the point. This is what a margin question and a trust question look like when you draw them. What actually moves it in order: the gross margin guide for next quarter, the conversion rate on those orders, the outcome of the board's review, and the inventory unwind. 3 of those 4 get answered on Tuesday's call. You can score this yourself the same night. Quick, honest ask, this show is brand new and every one of these models takes days to build. If you want to see the next stock on this table, the subscribe button is how you vote. It genuinely decides whether this series continues. Last board, and the framing matters more than the number. This is not a prediction, it's a stress test. We borrowed the worst crashes in market history and asked one question: if it happened again, where would the math land? Applied to the 52-week high of $58.78, the Microsoft path lands at $21.75, the Nasdaq path at $12.93, Intel at $10.58, and both Cisco and this stock's own 2024 path at $8.23, against a fundamental floor of $16.59 against the fundamental floor. And this stock has already done it once. Minus 85%, 2024, no bubble required, just an auditor with a pen.
Run this twice. Here's what that got us. If you believe the margin, the models land at $65.13. If you price the record, they land at $26.23. Same company, same filings, same set of public numbers. The gap between those two numbers is not a valuation argument. It's the price of trust, and you can read it off the board. So, Friday's close, $31.13. The model's perfect price, $45.68, which puts the chip at undervalued going into Tuesday. That's not a recommendation, and it never will be. It's what the arithmetic says when you feed it public numbers and refuse to flatter them. And here's the part I care about. Going in, the market has already bid this back to 9 times forward earnings, while 15% of the shares stay sold short. The models say the same filings support $65 and $26 at the same time, and Tuesday's margin guide is the number that decides which of those you have been holding. Charles Liang is 68 years old. He's been running this company since 1993, and Forbes had his fortune above $6 billion in 2024 and under $2 billion now. He wrote the same chart you did. That doesn't make him guilty of anything, and it doesn't make the $60 billion real. Both of those things stay true at the same time, which is exactly why the models get run twice instead of once. None of this is financial advice. These are deep models built on public numbers, and every model on this board has been wrong before. That's exactly why we run all of them. And the models are timeless. When the next quarter lands, rerun them with today's numbers, because that's the only version of this that stays true. This week, another AI stock reports that one owes $35 billion and its profit margin depends on how long a graphics card lives. The models price it on the channel.